Silver just did something that almost nobody predicted. It shot up to $121 per ounce. Then, in a single day, it collapsed 36%. Gone. And right now, it is sitting at $77 while every mainstream headline is screaming that the bubble has burst, that the party is over, that silver was just another speculative frenzy and now reality has finally arrived. But what if that story is completely wrong? What if the crash was not a collapse but a trap? What if the exact moment everyone is running away is the exact moment to pay the most attention? Today, I am going to show you why the dip is not the end of the silver story. It might be the most important chapter. I have been managing money for nearly 50 years. I have studied every market dip, every institutional trap, every manufactured flush designed to shake out retail investors since the 1970s. And what is happening to silver right now is the most perfectly engineered setup I have seen in decades. I am going to walk you through the real numbers behind the crash, the supply math that the mainstream media is not talking about, the Stanford research that just changed the entire demand picture permanently, what China is doing right now, and why February 27th is a date that could change everything for silver holders. Stay with me, this one matters. Before I go any further, please like this video if this kind of analysis is valuable to you and subscribe my channel. It genuinely helps this channel reach more people who need to hear this information. Let me start with what actually happened when silver crashed, because the official story and the real story are two very different things. The mainstream version goes like this. Silver got overheated. Retail speculators pushed it to irrational levels. The market corrected. Story over. Here is what the data actually shows. While silver was surging, the CME Group raised margin requirements to 60% through a series of rapid hikes. What does that mean in plain language? If you were holding silver futures using borrowed money, you were suddenly required to wire in massive additional cash within hours, not days, hours. And if you could not do that, your position got automatically liquidated. Most everyday traders do not have that kind of cash sitting idle, waiting to be deployed at a moment's notice. So they got forced out. Their positions were automatically sold. And that selling triggered more margin calls, which triggered more forced selling, which triggered even more margin calls. It was a cascade. And it was triggered by the exchange itself. Now here's the detail that should make you stop and think. While futures prices were crashing nearly 50%, silver mining stocks only pulled back 20 to 25%. Think about that. If the bull market was genuinely finished, if the fundamental case for silver had actually collapsed, mining stocks would have fallen just as hard or harder. They did not. The people who operate silver mines, the people who understand physical supply better than almost anyone else on Earth, did not believe the crash. They held. Because they know what is in the ground and what is in the vaults. And what is in the vaults is running out. Let me tell you about someone I know. I will call her Catherine. She is 58 years old and had been following the silver thesis for 18 months. She understood the supply deficit. She understood COMEX. She had a meaningful position in physical allocated silver. When silver hit $121, she felt completely vindicated. She called me and said she was thinking about selling half her position to lock in profits. I told her to look at the delivery data first before making any decision. She did. And what she found stopped her cold. January deliveries were 7 times the level seen in January 2024. The drainage rate from COMEX vaults had accelerated to 785,000 ounces per day. And March open interest was building to levels that made the available inventory look almost irrelevant. She held her position. Then the crash came. Her account value dropped dramatically. She called me again, this time genuinely scared. And I told her the same thing I am telling you right now. Catherine, look at what happened to the physical premium. Even while the paper price was crashing to $78, physical silver in Shanghai was trading at $15 to $20 above the paper price. The paper market said $78. The physical market said $95 to $100. One of those markets was telling the truth. You cannot fake a silver bar sitting in a vault, but you absolutely can fake a futures contract. Catherine held her physical silver, and within days, the recovery began. Do not be the person who sold physical metal to chase a paper price. Now let me give you the numbers that make this dip look like a trap. The March 2026 COMEX silver contract represents 528 million ounces of exposure. Against that, only 113 million ounces of registered silver exist and are available for delivery. That is already a problem, but it gets worse. Since October 2025, COMEX registered inventory has fallen from 167 million ounces down to 113 million ounces. That is a 32% collapse in just 4 months. And the drainage rate has now accelerated to approximately 785,000 ounces per day. At that pace, by February 27th, registered inventory could fall to around 85 million ounces, against 528 million ounces of delivery obligations. Even if only 20% of contract holders demand physical delivery, which is actually a conservative estimate given what we saw happen in January and February, COMEX would need 105 million ounces it simply does not have. The math does not work. It cannot work. And February 27th is the day the market has to face that math directly. February 27th is the first notice day for March 2026 COMEX silver contracts. This is the date when contract holders must declare whether they want physical silver or they will accept cash settlement. When the number of people demanding real metal collides with an inventory that cannot satisfy that demand, something has to give. Now here is the new information that most analysts are completely missing. The United States government has officially added silver to its critical minerals list and launched what they are calling Project Vault, a program designed to stockpile critical minerals domestically. You do not take those steps when a commodity is plentiful. You take those steps when you are looking at a genuine supply crisis and trying to get ahead of it before it becomes an emergency. The US government is now actively competing for physical silver. At the same time, the SPDR Physical Silver Trust announced it has doubled its capital raise program to $2 billion specifically to acquire physical silver bullion. At current prices, that is approximately 18 million ounces of physical silver. That is roughly 16% of current COMEX registered inventory being chased by a single institution through a single capital raise. And they are not the only buyer in the room. Then there is the Stanford research. This one is big. On January 16, 2026, Stanford University published research in Nature Materials showing that a nanoscale silver coating can solve the cracking problem that has plagued solid-state batteries for years. Silver-treated solid electrolyte surfaces become 5 times more resistant to lithium intrusion damage. The implications for demand are enormous. Current lithium-ion electric vehicles use around 25 to 50 grams of silver per vehicle. But Samsung's solid-state batteries, using silver carbon composite anodes, could require approximately 1 kilogram of silver per 100 kilowatt-hour battery pack. If solid-state batteries reach 50% adoption in electric vehicles, automotive silver demand alone would exceed the current total global industrial demand for silver. That is not a minor increase. That is a potential order of magnitude transformation in demand, and it is arriving precisely when global supply is running out. This is not theoretical speculation. Samsung is partnering with BMW for evaluation vehicles in late 2026. The timeline is real, the demand is real, and the silver needed to feed it does not exist in the quantities required. Now let us talk about China, because this part is critical and most Western investors have not connected the dots yet. China officially classified silver as a strategic asset on January 1st, 2026. Export restrictions are now in place. Only 44 companies received authorization to export silver through 2026 and 2027. China represents 60 to 70% of global refined silver supply. When the country that refines most of the world's silver restricts its own exports, That is not a neutral development. That is a fundamental shift in global supply dynamics. But here is the deeper play. China knows the COMEX is under maximum stress heading into February 27th. They know Western physical supply is critically tight, and they are not trying to trigger a COMEX default directly. Instead, they are positioned to benefit enormously when the paper market loses its ability to set the physical price. When forced margin liquidations push the paper price down while physical silver in Shanghai trades at $20 above spot, China sits on the largest strategic silver reserve in the world. They are not panicking. They are patient. And February 27th is their moment to step in on their own terms. Now, I want to address the counter-argument honestly, because serious analysts have raised it and it deserves a fair response. Some analysts have pointed out that a COMEX delivery does not necessarily mean physical silver physically moves. A delivery is technically a transfer of a warehouse receipt. Ownership changes, but the silver stays in the vault unless the new owner decides to withdraw it. That is technically accurate, but here is what that argument misses. The withdrawal rate from COMEX vaults is currently 785,000 ounces per day. The new owners are not leaving warehouse receipts in the system. They are taking physical delivery and they are moving the metal out. That is exactly why registered inventory has collapsed 32% since October. The new owners are removing silver from the system entirely. And that is the definition of a supply crisis, regardless of what the delivery mechanics look like on paper. So what happens on and after February 27th? There are really three possible paths. In the first path, COMEX manages the delivery crunch by converting eligible silver into registered silver and avoiding a technical default. The paper price stabilizes, but physical premiums expand dramatically because industrial users still cannot get metal at paper prices. The paper market survives structurally, but loses its function as the real price-setting mechanism. Silver reprices over the following months as the market discovers what physical metal actually costs. In the second path, COMEX raises margin requirements again before February 27th. The paper price crashes again artificially. Physical holders who understand the thesis use that window to accumulate more real metal at temporarily suppressed prices. Industrial demand continues growing regardless of what the paper price does. The paper price eventually catches up to physical reality. In the third path, delivery demand exceeds what the exchange can manage. Force majeure is invoked. Cash settlement is imposed on contract holders. Paper contract holders receive dollars, not silver. The paper price becomes essentially irrelevant. Physical silver commands a permanent and substantial premium. A two-tier market becomes the new standard. In all three scenarios, physical allocated silver is the right position to hold. In the second and third scenarios, it wins dramatically. Here is what you should do right now. If you sold silver during the dip, understand that you may have sold directly into an engineered trap. The structural thesis has not changed. It has actually gotten stronger. The question now is whether you want to rebuild your position before February 27th or after. If you are still holding physical silver, hold it. The paper price falling to $77 does not change the fact that you own real metal that industrial users around the world desperately need. Watch the physical premium over the paper price. That is your real signal. When premiums surge, the paper price is fiction. If you are looking to add to your position, focus on premium data more than spot price. When physical silver is available at or near spot, that is your window. When premiums start expanding again, the window is already closing. Move away from ETFs toward physical allocated metal. The crash proved that paper silver can be driven to any price the exchange chooses through margin hikes. Physical silver cannot be margin hiked. It exists or it does not. And right now, it is running out. One final thing to keep in mind. February 17th is Chinese New Year. Physical buying from Asia pauses for roughly 7 to 10 days. That pause, combined with continued vault drainage, means the window before the next surge is very narrow. When Asian buying resumes after the holiday, it collides directly with February 27th delivery pressure. That collision is the setup. The dip was engineered. The narrative that the bull market is finished is false. The numbers tell a completely different story. 528 million ounces of delivery obligations, 113 million ounces available, and falling by nearly a million ounces every single day. The US government stockpiling silver, SPDR doubling its physical acquisition program, Stanford research showing solid-state batteries could require a kilogram of silver per electric vehicle, China holding the world's largest strategic silver reserve with export restrictions locked in. These are not the signs of a commodity whose moment has passed. These are the signs of a commodity in the final stages before a structural repricing that most of the market has not priced in yet. The trap has been set. The question is which side of it you are standing on. Subscribe to ConInvest's right now. Share this with someone who sold during the dip and needs to understand what actually happened. The people who know what is coming are accumulating physical silver while the crowd is reading headlines about bubbles bursting. Do not let that be you.